Wall Street seems to have a single number in mind for Tesla's future. It's a number that promises a complete revolution in AI, in robotics, and transportation. And it's all supposed to happen in 2026.
$3 trillion. Just let that sink in. That is the valuation Wall Street has stamped on what they're calling Tesla's monster year of 2026. This is the year they say that the company stops being just a car company and morphs into something else entirely.
And the story they're telling is pretty simple, right? Tesla finally becomes a true AI company. It gets those high-margin, infinitely scalable software businesses that Wall Street just loves. We're talking full self-driving, Optimus robots, a whole cybercab fleet. This is the dream that $3 trillion bet is built on.
But what if that entire AI dream is being built on a physical foundation that's actually about to crack? What if there are 3 silent, structural risks that the market is just completely ignoring, and they're all set to detonate in the exact same year? By the end of this, you're going to understand the 3 major forces converging to create what could be a perfect storm for Tesla in 2026.
So this first threat, it has nothing to do with code or algorithms. Nope. It's all about steel, chemistry, and hundreds of thousands of real customers. It's a problem that has been quietly growing for 8 years, and it's called the service cliff.
This number right here is the key. 245,240. That's how many cars Tesla managed to deliver back in 2018, during its infamous production hell. You remember that, right? This was the group of cars that really made Tesla a mass-market company, and every single one of them has an 8-year powertrain warranty that expires, you guessed it, in 2026.
Now, this is a massive financial shock just waiting to happen. For 8 years, Tesla's most loyal fans, the early adopters, have had total peace of mind. A major powertrain failure cost them absolutely nothing. But starting in 2026, that same failure suddenly becomes a $15,000 bill out of nowhere. I mean, that's a cost that could wipe out more than half the car's value, just like that.
And this isn't just a financial problem for the owners. It's a logistical nightmare for Tesla. You got to think about it. Just as this huge wave of aging, out-of-warranty cars is about to hit, the service network is already stretched super thin. It's dealing with exponential fleet growth, it's burdened by recalls, and it is completely unprepared for the kind of zero downtime needs of a brand new robotaxi fleet.
This is where you get a really dangerous negative feedback loop. Insane wait times for repairs, that just destroys brand loyalty. And a reputation for expensive, hard-to-fix cars, that tanks the value of their used vehicles. And you know what happens when used values fall? It gets a lot harder for Tesla to offer attractive leases, which then chokes off demand for new cars. The whole financial engine is suddenly at risk.
But the pressure isn't just coming from inside the service centers. Oh no. At the exact same moment this service cliff hits, the walls are closing in from the outside. A massive geopolitical pincer movement is targeting Tesla's 2 most important markets outside the US, Europe and China.
Look at this timeline. This is not a coincidence. In China, you've got new data security laws that become fully enforceable on January 1st, 2026. And over in Europe, the Data Act and these really strict battery passport rules are also locking into place. It's the timing, the synchronization of it all. That's the real threat.
In China, the risk really boils down to this term, intelligence island. See, Tesla's big advantage with full self-driving comes from training its AI on data from a global fleet. Well, China's new laws threaten to trap all the data from its millions of Chinese vehicles inside the country, totally cutting it off from Tesla's supercomputers in the US. This could force Tesla to develop a separate, probably inferior, version of FSD just for China, which would kill its biggest competitive edge.
Meanwhile, in Europe, the regulatory wall attacks the business from a bunch of different angles. The battery passport could flat out block cars made with Chinese parts from even entering the EU. The Data Act, that's going to force Tesla to share its valuable diagnostic data with independent mechanics, which basically ends its monopoly on service. And, of course, rising tariffs could completely destroy the profitability of exporting from its huge Shanghai gigafactory. So the bottom line here is that the very model that made Tesla a global powerhouse is at risk of falling apart. By 2026, Tesla could literally be trapped, unable to move data out of China to train its AI, and unable to move cars out of China to make a profit. Its entire engine for global growth could just seize up. So we've got internal problems and external problems. But what if the greatest threat to Tesla's car business in 2026 isn't a regulator or a competitor, but Tesla itself? What if the company's insane success in a totally different area starts a civil war over the one resource it absolutely cannot live without? The internal battleground is the battery cell. For years, the automotive division got pretty much all of them. But look at that other slice of the pie. Tesla Energy. It's growing like crazy, and it's about to demand a much, much bigger piece.
And the reason for this is the explosive growth of AI data centers. I mean, they consume just staggering amounts of electricity, and they need giant batteries like Tesla's Megapacks to keep the power grid stable. The demand is basically infinite, and the profit margins are huge. So this creates a really brutal choice for Tesla. Do you use your finite supply of battery cells to build a car, or to build a Megapack for the power-hungry AI industry?
And just as this internal resource war is about to erupt, the price of the key ingredient is set to spike. After a few years of falling lithium costs that really helped Tesla's margins, most analysts are predicting the market is going to flip back into a deficit in 2026, driving up the cost to build every single battery.
Okay, so let's connect all the dots. The service cliff, the geopolitical pincer, the resource conflict. You see, these are not three separate risks. They are three massive weather fronts, all converging in the same year to create a potential perfect storm.
Let's just walk through how this storm could play out. First, the service crisis damages the brand and spooks the used car market. Second, these geopolitical walls cut off access to both data and export profits. Third, the company's own energy business starts eating up the battery supply needed for cars. And fourth, just when Tesla really needs to cut prices to stay competitive, rising material costs make it impossible. This convergence creates what some analysts call the valley of death. You know, that really dangerous period where sales of your current products, the Model 3 and Y, are slowing down, but your next generation platform just isn't ready to pick up the slack. For Tesla in 2026, this valley threatens to become a massive chasm. And this really highlights the huge disconnect we're seeing. On one side of the scale, you have Wall Street's $3 trillion AI dream, a valuation that basically assumes flawless execution. But on the other side, you have the messy physical reality, an operational, geopolitical, and resource crisis that looks set to hit all at once.
Which really leaves us with this final question. For a decade, Tesla's story has been all about the infinite possibilities of software. But 2026 is shaping up to be the year where the harsh, finite limits of chemistry, of international law, and of physical logistics finally make their stand. The AI dream is powerful, for sure, but it still has to operate in the real world.